All right, today we're doing a full-on autopsy on a stock that had an absolutely catastrophic collapse all in a single day. We're going to dig into the data, we're going to analyze the panic, and we're going to hunt for any signals hidden inside the wreckage. So let's get right into it. So here it is. This is the number that kicked this whole thing off, a gut-wrenching drop of over 21%. I mean, just imagine, nearly a quarter of your investment vanishing before you've even had your morning coffee. This wasn't some slow bleed. This was an absolute freefall. And that's the really crazy part. This entire financial drama played out in just a few hours. That speed, that severity, that's what makes this so wild, and why we need to take a much closer look. So, what on earth was going on here? Okay, first things first, let's really dig into the anatomy of this panic. We've got to look at the raw evidence from the sell-off to truly understand the sheer force behind that 21% nosedive.
Yeah, this wasn't some quiet little dip. This was a deafening stampede for the exits. Just look at this chart. The day before, you had about 1 million shares traded. Pretty normal. But on the day of the crash, it exploded to almost 12 million. That's a tenfold increase. It's the clearest sign you can get of a massive, panicked rush to sell.
And you know there's a name for that kind of stampede. It's called panic selling. It's what happens when raw fear just completely takes the driver's seat and all that rational, careful analysis gets thrown right out the window. That huge spike in volume we just saw, that is the classic fingerprint of panic.
You see, a drop this big, it doesn't just sting your portfolio. It completely shatters the technical foundation of a stock. So let's assess the damage. We're going to look at the key support systems. Think of them like safety nets that were supposed to catch the price, and you'll see how every single one of them just snapped.
Okay, so this table, it tells a pretty brutal story. Let's talk about these moving averages, or SMAs. The 50-day and the 200-day are like those safety nets I mentioned. That 200-day average, around $73, that's supposed to represent the long-term health of the stock. Well, as you can see, the stock didn't just fall through these nets, it absolutely blasted through them. That's a signal of a complete and violent breakdown.
And here's the really tough part about that. What used to be a floor, a level of support, has now flipped. That 72.90 level has morphed into what traders call an iron ceiling. It's now a huge barrier that the price is going to have a really hard time breaking back above.
Okay, so everything looks pretty bleak, right? A total technical disaster. But, and this is a big but, inside the chaos of a market crash, you can often find these hidden signals, these little whispers that suggest maybe, just maybe, the panic has gone too far. So now we're going to switch gears from looking at the damage to searching for a potential bottom.
And that's the million-dollar question, isn't it? This is what the contrarian investors start asking themselves when everyone else is running for the hills. Is there an opportunity here? Has the reaction become totally unhinged from reality? Let's see what the data has to say.
So our first clue comes from something called the RSI, the Relative Strength Index. It basically measures the speed and change of price moves. Now, anything below 30 is what we call oversold, and at 23.01, this thing is deeply oversold, which hints that the selling pressure might just be running out of gas.
Okay, so if the RSI was a warning flare, this next one, the stochastic RSI, it's a full-blown siren. It is at absolute zero. A zero, that is an extremely rare reading that points to one thing: maximum seller exhaustion. It basically suggests that pretty much everyone who was going to panic sell has already done it.
So just so we're all on the same page, what does oversold actually mean? Well, simply put, it means the stock has been hammered so hard, so fast, that it becomes statistically likely to see a reaction in the other direction. Now, this doesn't guarantee a full recovery, not at all, but it does make a short-term bounce, a rebound, pretty likely.
And get this, here's one more piece of the puzzle. Based on its previous trend, the stock's price was projected to be up around $84. Right now, it's trading almost 21% below that. A deviation that huge from the trend is statistically rare, and you know what that does? It tends to attract bargain hunters who are betting on a snapback to the average.
Okay, so we've got some signals pointing to a possible bounce. But, and you knew there was a but coming, before anyone gets too excited, we have to talk about the incredible danger here. This is not a safe, cozy environment. This is a high-stakes balancing act on a razor's edge.
You know, there's a classic saying in investing that just perfectly nails this situation. When a stock plummets this fast and this hard, they call it a falling knife. And what's the #1 rule when you see a falling knife?
You don't try to catch it. Seriously,
Trying to time the exact bottom is incredibly risky, and you can get hurt badly if you're even a little bit wrong. Remember, even if the sellers are exhausted, the downward momentum is still ferocious.
And we can actually put a number on this danger. It's called the average true range, or ATR. Right now, it's telling us that the stock's typical daily price swing has exploded to nearly $4. That means on any given day, the price could easily swing up or down by $4. That is extreme volatility, and it's something you have to respect.
So, let's recap. We've got a complete technical breakdown on one hand, and on the other, these extreme oversold signals screaming that a bounce could be coming. We've got incredible risk, but also this statistical probability of a rebound. So what's the verdict? How do you even begin to navigate this mess?
Well, what this all boils down to is that there are really two very different ways to look at this. And it all depends on your stomach for risk. The aggressive trader, they might see a shot for a quick scalp trade, maybe buying near that $62 to $63 support, aiming for a quick pop to $69. But the conservative investor, they should probably stay far, far away and wait for actual proof that the storm has passed, like seeing the price fight its way back above that iron ceiling at $72.90.
And that really leaves us with the ultimate question that comes up in every single market crash. Is this a danger you should run from? Or is it a rare opportunity that was born from pure fear? As we've seen from all the data, the real answer is it's both. It's both, happening all at once. The real key is knowing which one of those paths is the right one for you.